How you doing? I'm Big D. Welcome to the show. I'm going to try to make this as quick as possible, but I think you need to know this before tomorrow morning about the silver prices that could possibly happen overnight. Well, actually, that's been happening since Friday night as the close of the silver market. Close of the silver market, as per JM Bullion, was $103.93, 190.94 cents. Depends on where you got your information. And there's a lot that you need to know before the opening of the market tomorrow. Now, Sunday morning, January 5th, 25th, 2026, the market is closed. Most of the world is resting. Most of you think the silver price is still around $103.93. If you are believing in that, then you are probably already one of the victims of gap up. That's at least what they're telling us. While you slipped through Friday night, Saturday night, now Sunday morning, the global financial system quietly enters a crisis mode. And most retail investors won't realize that what is happening until already too late. Gray market trading, the overnight whisper network, where institutional money moves before the official open, and it's possible as high as $115 tomorrow morning, maybe even more. I don't know. But keep aware of what could possibly happen. Now that's a 5-ish% gap from Friday, New York COMEX close. And if you think that's shocking, technical analysis are now pointing at maybe even much higher than $115. And that would be the next resistance level of momentum holds through Monday's Asian session. This is your final briefing before Black Monday. This is what they're calling it. Before Black Monday begins, if you want to stay ahead of the herd while the mainstream media sleeps, make sure you subscribe. Hit the bell notification so you get all of the notifications. And please hit the like button. I do appreciate it if you make a comment. And if you make a comment, I will leave a comment for you. We are the only ones covering this timeline. But here's what should terrify you. While you are relaxing this weekend, the U.S. physical supply chain just, I'm going to say, collapsed. I'm going out on the edge. I'm going to say it collapsed. The biggest bullion dealer in America have effectively turned off the buy buttons. APMEX suspended pre-sales. JM Bullion is quoting 15 business days before fulfillment. That's 3 weeks, not 3 days, as usual. Yes, the bullion slaps purchase limits across their entire product line. This isn't a glitch in the system. This is the system breaking in real time. In less than 12 hours, the Asian market, now it's considerably less because I tried to do this morning, Tokyo, Singapore, Shanghai, and when they do, the price discovery mechanism that kept silver orderly for decades is about to face its most severe stress test since the Hunt brothers tried to corner the market in 1980. Let me take you in what happened inside Saturday, January 24th, while most Americans were shopping, watching football, simply enjoying life. APMEX, America's largest bullion dealer, didn't just slow down operations, they fundamentally changed how they do business. 2 weeks ago, their CEO sent a letter to customers announcing unprecedented demand that required immediate operations restructuring. Shipping delays extended from their standard 1 business day to over 4. That's a 400% increase in process time. But here's the detail that matters. Out of 31 core products that APMEX normally keeps constant inventory, products they've sold continuously for years, only 21 were actually in stock. By mid-January, 10 products simply vanished from the available inventory. These aren't exotic collectibles either. These are standard 1 ounce rounds, 10-ounce bars that normally have a limited supply, or have a limited supply because multiple mints produce them simultaneously. COMEX suspended the majority of their pre-sales listings unless they felt confident that they could ship the product within 2 weeks. Now remember this. I'll say it again. The largest dealer in America is now refusing to take orders for products they don't physically have in their warehouse. That's not normal market behavior. That's survival mode. I want to pause, okay? This is the kind of the ground data that CNBC and Bloomberg won't show you until it's too late. If you value this level of research and want to keep us exposing the physical shortage, hit the like button right now, because I don't have a lot of people helping me out, but they want to see some increase in subscribers. They want to see more comments, or otherwise, will they still help me? I don't know. I do appreciate it. I appreciate everybody that has everything to do with this show. And I appreciate you for stopping in and listening to what I have to say. Now it tells the algorithm that this information matters by you doing that, hitting the like button, subscribing. Okay, let's keep going. It does get worse. They implemented a $10,000 minimum on buyback orders. Think about what that signal means. When a dealer raises their buyback threshold by an order of magnitude, they're telling you that they need to conserve inventory. They're telling you that they can't afford to let metal walk out the door or current prices because they don't know if they can replace it. JM Bullion followed the same pattern. Customers report flooding Reddit throughout January, describing orders placed in late December still showing label created status with no tracking information or movement of that product by January 14th. That's a 2-week process backlog on what should be the same fulfillment. Their official website quotes 15 plus business days for order completion. That effectively means if you order today, you might receive your order of silver by mid-February. Generic 1 ounce rounds at JM Bullion are now flagged as limited quantity. These are products that normally have unlimited supply because multiple mints produce them. When unlimited supply products become limited quantity products, you're watching physical market disconnect from the paper market in real time. The SD Bullion issued an official notice on January 3rd announcing temporary purchase limits on select silver products due to unprecedented demand and supply chain disruptions. Are you getting nervous? Now, by late January, their delivery warnings escalated from 7 to 10 days delay to availability by March 31st for certain products. That's not a supply or a shipping delay. That's a forward contract on products that doesn't exist yet. Now let's talk about what happens to premiums, because it is where you see the panic in the data. In normal market conditions, 100 silver bars traded at $2 over spot price. That's the standard dealer margin. It's been that way for years. This weekend, those bars are trading at $4 to $8 per ounce over spot. Some dealers are quoting $8 to $10 over spot by February delivery for metal that doesn't ship for 3 weeks. That represents a 400 to 800% increase in dealer margins. When dealer premiums explode by 400%, you're not looking at a normal supply and demand adjustment. You're looking at a run on the bank. Quick question, and I want you to be honest in the comments. Have you tried buying physical silver in the last 48 hours? I did. I called 2 different places. One is a coin shop, and one is a local pawn store, but they usually sell a lot of silver. They have an actual silver supplier. It's not like they buy it from individuals and then sell it back to individuals. This is kind of a go-to place. They're usually $2 to $4 over spot, depending on what you're looking at. But silver rounds or just a generic bar, it's usually about $2 over spot. They don't have any. And they don't seem to be caring if they sell any. And that caught me off guard. But it's the way it's going, I believe. Now, do you face these delays? Did you, if you've gone on to Jam Bullion or any of the higher where you can buy multiple amounts or multiple types of silver, any of that stuff? I'd love to hear about it. But I want to see how widespread this is. And it's not just the American dealers. The Royal Canadian Mint, the TD Bank in Canada, showed out of stock on nearly every silver bar product by early January. This is a coordinated continent-wide inventory crisis. Here's what the dealers won't tell you, but their actions reveal. They increased customer service headcount by 25%. They suspended sales of numismatic collectible silver to evaluate pricing, which is dealer speak for we have no idea what this metal is actually going to be worth. I mean, it's changing so rapidly. I mean, we all know how volatile silver and gold prices are, but this sounds like to be incredible. They've turned off pre-sales, implemented purchase limits, extended shipping times to 2 months, raised buyback minimums to conserve inventory. When the 3 largest bullion dealers in America all take the same defensive actions during the same weekend, it's not a coincidence. It's coordinated, born from panic. Coordination born from panic, sorry. The verdict is clear. Major dealers did halt sales through pre-sale suspensions, and they did slap shipping delay warnings across their websites throughout January. Wait till February or even March. But more importantly, weekend premiums confirm an acute physical tightness heading into Monday's opening. You can't buy silver at spot price anymore. And it's been a while since you've been able to do that, but not in any meaningful quantity. Not for immediate delivery. The premium you pay now is the market's way of telling you the official spot price is a lie. Now let's turn to Chile, because what's happening on Saturday in Antofagasta region is the supply shock that Friday's closing price didn't account for. But Monday's opening price will, I do believe. Now, the mine in Escondida, I believe I pronounced that correctly, the single largest copper deposit on planet Earth, producing nearly 5% of the global copper supply, remains under siege, entering in its 4th week. And on Saturday, January 24th, the situation didn't improve. It escalated. Striking workers from Finning Union number 2 resumed their blockade of the mine route, collecting BHP's Escondida and Antofagasta minerals, Salvador mine to the port city of Antofagasta. I hope I didn't screw up those. But I read this several times and tried to come up with the right ones. So my apologies if that happened. Now, police had cleared the protest late Friday, and Saturday morning it was back. The BHP's vice president confirmed that the operation's impact. Our company has been affected for 4 days by a third-party conflict. The blockades on the mining route have led to intermittent vehicle traffic to and from in our operations, with delays and shift changes. Let me translate the corporate language, into English as far as I understand it. Workers can't get to the mine. Supplies can't reach the operations. Fuel deliveries are disrupted. And when a mine can't rotate shifts and can't refuel, product doesn't slow down, it stops. Now, BHP hasn't confirmed a complete fuel cutoff. They're being very careful with their language. But here's what we do know. The blockade affects transportation of both supplies and personnel. Fuel is a supply. Fuel shipments require transport, and this transport route is blocked. You do the math. This isn't BHP's first rodeo in Escondida. Disruptions. The mine faced strikes in 2006, 2011, 2015, 2017. The 2017 strike lasted 43 days and cost BHP approximately $1 billion in lost revenue. In each of those previous disruptions, BHP declared force majeure. Again, I am trying to do my best at their pronunciations. Now, the legal mechanism that allows them to suspend contractual delivery obligations due to circumstances beyond their control. Typically, BHP declares force majeure within 2 to 3 days of a major strike beginning. We're now on day 4 of confirmed operation disruption from this blockade. And as of Sunday evening, BHP has not issued a force majeure declaration or client alert regarding potential delivery failures for Monday. Now that silence is deafening. Either BHP maintains sufficient inventory buffers to continue deliveries in the short term despite the blockade, and or this is the scenario that should concern you. The declaration is being prepared for release during Asian trading hours, Monday morning. Time to minimize panic in Western markets that are still closed. Here's why the matters beyond copper. Escondida is a copper mine, but as many of us already know, copper mining produces silver as a byproduct, or a significant byproduct, especially for this mine. When you disrupt 5% of the global copper production, you're simultaneously disrupting a meaningful percentage of global silver byproduct flows. And in a market already experiencing structural deficits for 5 consecutive years, any supply disruption becomes a crisis multiplier. The Chilean government has not declared a state of emergency in the Antofagasta region. BHP's vice president issued an urgent call on Friday for authorities to resolve the situation so operations can continue under appropriate conditions. But the plea went unanswered over the weekend. Here's the reality that Friday's closing market of $103.93 per ounce didn't price in. The blockade resumes Saturday. Shift changes remain blocked. Fuel supplies are disrupted. Production is compromised. And when the Asian market opens in less than so many hours now, when I was getting this script together, it was about 12 hours. But I'm thinking we're only a few hours away. Now, they'll be pricing in a Chile situation that is worse today than it was on Friday. Not better. The Friday closing price didn't account for Saturday's escalation. The Monday opening price will, at least my belief, unless they still act like it's, no big deal. Now, we need to talk about the note that's been circulating through the International Institutional Monies Management Office all weekend. The Bank of America research report that fundamentally rewrites the rules of the portfolio allocations, published January 22nd and 23rd. Bank of America's chief investment strategist, Michael Hartnett, made a call that no major Wall Street bank had been willing to make publicly. Gold is going to $6,000 per ounce by spring of 2026. I'm not saying that. I'm just giving you the report. I believe it will because of the things I'm seeing. But not by 2030, not by 2028, but by spring 2026. Meaning the next 2 to 4 months, his methodology is straightforward, terrifying in its implications. He looks at an average gold price movement across the past four major bull markets and found that gold tragically jumps approximately 300% over 43 months. If you apply that historical pattern to the current cycle, you get $6,000 per ounce by spring. Gold closed Friday at just shy of $5,000, if I remember correctly. Bank of America is calling for another 20% upside in 8 to 16 weeks. But here's the part that matters for silver. There's not just forecasting higher gold prices. They're recommending that investors fundamentally restructure their portfolios. Current central bank holdings average 15% of the reserve, already exceeding their holdings of U.S. Treasuries in many cases. Bank of America optimized allocations target is 30%. They're telling central banks, pension funds, sovereign wealth funds, and family offices that they should double their gold purchases to reach properly optimized reserve positionings. Think about what that means in practical terms. High net worth portfolios currently hold about 1%, about half of a percent in gold, despite gold representing 4% of the total global financial assets. Institutional investors and massive underweight relative to both market capitalization and Bank of America recommended allocations. If institutes move even halfway towards Bank of America's 30%, you're talking about trillions of dollars of capital chasing limited physical supply. And here's where silver enters the equation at the higher beta expression of global exposure. Bank of America's framework positions silver as an amplified gold play for risk-tolerant investors. They analyze the gold-silver ratio. Current trading is around 50 to 1, right? Compared to its historical lows of in 2011 when it hit a 32 to 1. In 1980, it reached 14 to 1. Simply returned to the 2011 ratio of 32 to 1. At gold prices, you're looking at $135 silver an ounce. If it matched the 1980 extreme of 14 to 1, you're looking at $309 an ounce. Now, Bank of America isn't forecasting $309 in silver. Their base case suggests that the fundamental justified level for silver would be closer to $60 per ounce, which means that current market price of $103 is already 70% above their fundamental fair value calculations, and they've been wrong multiple times in the past. Now that premium reflects either speculative excess or, this is the critical interpretation, a supply crisis premium that the market is pricing in ahead of its actual shortage materializing. But here's why this note matters beyond the price targets. Bank of America is the first major Wall Street bank to publish a $6,000 gold forecast for 2026. And they published it the same weekend that the Chile mine crisis escalated. The timing creates a dual catalyst for Monday's panic buying. When a bulge bracket bank recommends 30% portfolio allocation to a single asset class, it signals a paradigm shift in institutional risk management. This isn't a trading call. This is a structural positioning recommendation that pension funds and endowments and sovereign wealth managers will spend the next quarter implementing. And here's the institutional positioning data that makes Monday very, very dangerous. Hedge funds are sitting at a 22-month low in net long silver positions, and as of January 13th, they hold just 15,045 contracts net long, drastically underweight relative to current price momentum. Hedge funds increased their gold net long positions to a 16-week high, while simultaneously cutting silver exposure to multi-year low. That positioning creates that traders call a forced buyer scenario. If Bank of America note triggers institutional fear of missing out among pension funds and family offices this week, you could see trillions in capital chasing a market where the smart money is already underweight and scrambling to establish positions. Silver's total market capitalization is estimated at $1.5 trillion compared to gold's $15 trillion market. That means 1 to 2% institutional reallocation from gold to silver could overwhelm available physical supply. And speaking of industrial buyers, let's address the Tesla rumor that's been circulating through trading desks this weekend. On December 28th, 2025, Elon Musk sent a tweet that was unprecedented in its directness. This is not good. Silver is needed in many industrial processes. He was responding to silver's price surge and China's export restrictions that took effect on January 1st. And if you've been watching my shows, you know about what's going on coming out of China as far as exports to the West. If you want to see those, please check back on some of my older videos. Now, Tesla uses, or check out my playlist. Tesla uses silver in EV batteries for different contexts and solar panels and power electronics. Each electric vehicle requires significantly more silver than a traditional internal combustion vehicle. China export restrictions will reclassify silver for the commodity to strategic resources. Effective January 1st, cutting off primary supply chains for Tesla, solar, and EV productions. The rumor kept circulating on trading desks and that major tech companies, rumored to be Tesla, is preparing an emergency off-market buy order for Monday morning to secure physical silver outside normal exchange mechanisms. There is no confirmed reporting from Bloomberg, Reuters, or the Wall Street Journal supporting this rumor. As of Sunday evening, Musk's tweet expressed concerns about price level and industrial needs. But that doesn't necessarily translate into emergency procurement strategy. Tesla's normal price involvement, long-term supply contracts with miners, not spot market panic buying. But here's why the rumor persists. Industrial buyers in Shanghai have been paying $8 to $10 premiums over London in the COMEX prices to lock in supply before China's export ban fully restricts outflows. If any major manufacturer breaks rank and public buys physical silver Monday morning, it could trigger copycat orders across the tech and automotive sectors, creating a self-fulfilling supply squeeze. Whether Tesla specifically is preparing for an off-market order remaining unconfirmed speculations, but industrial buyer anxiety is real, measurable, and escalating. Now, the themes circulating in private and institutional notes this weekend tell the story. Silver has been structurally deficit since 2000, way before 2020, with a cumulative shortfall of 820 million ounces over the last 5 years. And I believe that number is just something that was thrown out there. I believe it's much higher than that. The 2026 deficit projected at 200 million ounces, which again, I believe it's much higher than that. You have new batteries coming out online. We have military reasonings that the supply alone in the military for missiles and things like that, and electronics that the military's requirements are, I think it's much higher than that. It's probably, my speculation is over 1 billion ounces every year. But we're never going to get that report or the truth, because then you would know how much they're probably building and putting into new planes, and uh, the amount of silver is mind-boggling, I'm sure. Now, J.P. Morgan's first COMEX delivery report of 2026 shows them aggressively standing for maximum physical delivery against short positions. The largest U.S. bank is converting paper contracts to physical metal. And here's the London problem that nobody's talking about. The LBMA eligible silver stock stands at 155 million ounces, while floating annual demand range from 900 million ounces to 1.2 billion ounces. London cannot backstop run on physical market. Monday's wild card. If even one major hedge fund announces significant silver allocations, algorithmic momentum buying could trigger before the U.S. cash market even opens at 9:30 Monday morning Eastern. So let's talk about what happens when the Asian opens in less than so many hours, right? Based on gray market indications, technical analysis, and positioning data, here's the forecast. Silver is expected to open between $116 and $120, with the base scenario pointing towards closer to about a 118. But again, speculation. I don't know what's going on. This is just something that I'm giving, and it looks like with the data, this is a possibility, a high possibility. That represents 5 to 8% gap from Friday's close at $103.93. The momentum holds and technical breakout triggers an algorithmic buying. The upside target is 115, 118 in the United States. The next major resistance level where profit taking could materialize. Volume expectations for Monday's session. Elevated activity from Shanghai, Tokyo, Singapore dealers scrambling for physical metal before the European session opens. The critical test comes at London's open, 3 hours Eastern time. If the London physical premium widens beyond $5 an ounce versus COMEX futures, it confirms global supply dislocation is accelerating. Here are the risk catalysts to watch overnight. Between midnight and 6 a.m. Eastern, monitor the Chilean government announcements, a state of emergency declaration, or a BHP force majeure notice would send prices sharply higher at the Asian market opens between 3 and 4 a.m. Eastern Time. The London LBMA spot pricing becomes critical. Watch the backwardization deepening, which signals immediate physical scarcity intensifying. But here's where the retail investors won't see until it's too late. Dealer pre-sale suspension means Monday's price spike cannot be accessed at spot by retail buyers. PMX, JM Bullion, JD Bullion have turned off pre-sale and implemented purchasing limits. Even if spot hits $110, retail will pay $115 to $120 after dealer premiums and shipping costs, looking at 5 to 10% premiums before any price appreciation. Delivery delays create hidden liquidity risks, and buyers ordering Monday may not receive physical metal until April 2026. If price correction 20% is interim back to 85, $90. They've locked in peak pricing and taken delivery at the worst possible moment. And here's the COMEX risk nobody's discussing. Registered silver inventory available for delivery against futures contracts. Well, that stands at just 124 million ounces, only 28% of the total COMEX inventory. Open interest for the March 2026 contracts, represents 58 million ounces of paper silver, over 4 times the registered supply. If delivery demands overwhelm registered inventory by Wednesday or Thursday this week, the COMEX may be forced to implement cash settlements. That means future longs get paid in dollars, not metal. Now, at potentially unfavorable settlements, price determined by the exchange. So here's what I believe. Here's my forecast. The gap of $18, or a gap up to $18, which $110 at the Asian Open is likely, or much higher. But I'll go at 110. But don't chase the spike at the Monday morning open. Let the panic wash out. The retail investor herd will panic buy into Monday's gap, providing liquidity for institutional sellers who accumulate positions. The smart money exists into strength. The dumb money chases it. For physical stackers, if you don't have metal in your hand, say by tonight, you're too late, I'm thinking, of what could possibly happen. Maybe I'm wrong. Boy, chasing premiums Monday morning is speculation, not hedging or wealth preservation. For future traders, the Asian gap up will likely fade into the London Open. As early longs take profits, wait for the retest of $100+ in the US before establishing a new position. For options players, implied volatility will explode at the open. Sell premiums, consider selling out of the money calls expiring in early February rather than buying inflation option prices. The convergence of 3 simultaneous crises, physical dealer shortages, Chilean supply disruption, and institutional allocation shift triggered by Bank of America's research creates the setup of extreme volatility Monday morning. Both volatility cuts both ways. The gap is coming. The question is whether you position ahead of it or chase it after it's already happened. If silver opens tomorrow morning and you buy or sell, let me know what you're going to do. I would love to hear which way you're going to go. I mean, are you nervous that it's going to go up and you're not going to have the silver? You're nervous that it's going to drop and you have all this silver and you're never going to be able to get your money back. I don't know. But please leave a comment in the comment section. I do appreciate it. I will leave a comment for you. And if you're in the path of the snowstorm, please be safe and God bless. Have a great rest of your day and I'll see you soon.